radio for a really great future. We're talking real money.
We're on hold, ladies and gentlemen. The podcast is on hold. It can't officially start until Tom enters the room. I'm watching carefully for any sign of life or activity from our Bellevue studio, and so far, I see no motion.
A few moments later.
Tom showed up for the podcast. Hi, everybody. I'm Don McDonald, always ready and raring to go in the Florida studio of Talking Real Money. Tom Cock finally moseyed on in.
Well,
to
my
the
age of mosey is a fast pace, so go easy, dude.
Yeah, you do mosey fast. You're a fast mosey.
Yeah, exactly.
He's a mosey faster. Hello, welcome to Talking Real Money. Don't know why I slipped into a bad British accent, but I did. This is the program designed scientifically to provide you with the education you need to stop doing stupid stuff when it comes to managing your money. And the stupid stuff we're talking about today is your expectations being a little out of alignment with reality. And let me start with an interesting little study that was reported by Morningstar. Natixis Investment Management, and I don't know who the heck they are, but they do a survey of 7,000 investors with at least 100 grand. And this survey asks about investors' expectations for long-term returns. Their latest survey shows that, on average, U.S. investors expect stocks, in aggregate, to generate average annual returns of over 12.5% per year. Now, the good news is that's down from 2023's expectation of, get this, 15.6% per year.
Now, okay,
what
but you
in the heck is wrong? What?
You left out one fact. They expect 12.6 per year before inflation.
Oh, that's right. Oh, over after inflation.
Yeah. So that would be more like
so sorry.
almost
I left
16%.
out that. Yeah, so that 15.6 would be like 18.6, almost 20% per year.
Yeah.
So, Tom, let's reality check this a little bit. Does that happen very often?
No, that does not happen. And in fact, just got the numbers recently from dimensional funds, and because they showed us a very nice a look at two of their funds. I have a 100% stock fund, DGEIX, from 2004 to 2024, 20 years. Mm-hmm. That made 8.9% a year. And
that's invested in?
That's 100% stock, pardon me.
100%
that's 100%
stocks.
Global stock, yep.
Global stocks.
Yep,
okay.
That's right. Yep.
Global, the whole
9%
market.
9% basically. Yeah.
9% per year.
16%.
Yeah.
And then their 60-40 one fund portfolio, DG6, 6.6% return. Which is closer to, if you look at the actual returns of real investors, you're getting closer to 6 to 7% for a variety of reasons, of which we will touch on some.
Well,
now.
because of diversification in the portfolios. I mean, part of that.
Well, no, I'm talking about bad acts. Yeah.
Oh, bad act. Yeah,
Most.
And you, boy, dude, you have the finger on the pulse of bad actors because you actually spend a lot of time looking at people's portfolios.
Yeah, I'm one of the lucky few that get to see this up close and personal. I'll give you a couple of recent stories. One couple just came in a few days ago that are getting ready to retire like right now. Said, hey, we called you because we want to quit like next week. Fine. Good portfolio, around $1 million. Great. But then open the statements and look, 100% in stocks, 100% in stocks, all in the Standard & Poor's 500.
Okay. Well, one, did you ask them why, heading into retirement, they were comfortable enough being 100% in stocks?
The answer is always, well, it's worked. It's made me a lot of money.
Yeah.
Yeah. but we'll talk
So
about
there
what
is
it could
there's
mean.
no good reason.
It's more by default than by design. And then the other couple that came in a couple weeks ago, similar story, a little bit more money, $2 million, great. All in stocks. Again, we'll talk about the reasons why that's risky, especially heading into retirement. It's risky anytime. But fascinatingly enough, a third of it in one stock. I won't mention the stock because then the person may recognize their portfolio. One not particularly well-known company, and guess what? It's the company of which they are employed. Yeah, of course.
Yeah. And of course, I know my company. I'm
right.
I'm.
These are
I
smart
work
people.
there, and-
Yep, they're really good.
and
There's
the
yeah,
CEO
et cetera.
tells me everything.
Oh yeah, I'm inside on the whole
Oh
thing.
wait,
Yeah.
even if the CEO is telling you everything, there's some precedent for CEOs claiming they're not in the loop. I seem to remember a guy by the name of Ken Lay who said, well, they didn't tell me the company was almost bankrupt.
Dragging Ken Lay up after 20
I am. I'm
speaking of 20
dredging
years.
up the body of Ken Lay.
Poor guy.
We've resurrected Ken.
That was Enron for those of you playing along at home, and you could go read that story or watch that story or do whatever you like. Okay, but so those are two recent examples that I've seen walk. And by the way, if that makes you nervous about meeting with me, it shouldn't, because I'm not mean to people. I just sort of say,
yeah.
tell me why you're doing this. I mean, help me understand.
You listen to the podcast.
I'm a nice guy.
You know that Tom, like on the live Saturday show, that you guys sometimes test his patience. It's like, what do you think you're doing?
But let's talk about the realities of investing in stocks and what this overconfidence, I think, this over-expectation can mean. A couple of things, and this came from the survey, that many people undersave because they think, well, I'm going to make, fill in the blank, 16, 19% a year, whatever it is, so I don't need to save 15 to 20%, right? I mean, because I'm going to make so much of my money, which is tragic because, as again, I say most surveys suggest investors make somewhere around 7% a year actual
That's
return.
real return. That's after inflation.
Yeah.
And Morningstar actually published the numbers for each decade for which we have data. By the way, we don't have a full decade in the 20s, but for the 3 years of the 20s that we have, that was the best period in U.S. stock history for real returns at 20%. But from 1930 to 39, it was 2%. From 1940 to 49, it was 3.5%.
Wow.
1950 to 59, the very best period, except for that 20s period, at almost 17% per year real return. But that was, remember, that was post-war economic explosion time, followed by, started to slow down a little bit, 60 to 69, we saw a 5% average annual return. The real return after inflation, now most of us, old people, lived through this one, 1970 to 1979, and I bet most people don't realize that during that period, the real return for U.S. large cap stocks was a negative 1.33%.
Boy, you weren't excited about investing in stocks if you woke up in 1980.
Nobody was, by the way. Because I became a stockbroker in the early 80s, and you couldn't give stocks away. Everybody was buying bond funds because interest rates were double digit.
No, that's a good point.
And it's funny because they were wrong, because the 1980s turned out to be very good with an almost 12% after inflation, and that was a high inflation period return.
It was. Yeah, that's good.
Then, just to wrap up the numbers, just so you have a complete picture of how it went, 1990 to 1999, a very good period at almost 15% real return. Here's the one. This is U.S. stocks, by the way. This number would have been positive if you had been invested internationally. But for U.S. investors in the lost decade, 2000 to 2000 through 2009, the negative real return was almost 3%.
Wow. So you lost money, but inflation took it down. Yeah, I mean, that's harsh.
3% average annual.
Yeah.
Then from 2010 to 2019, we got a 11.5%. And for the last 4 years, we're looking at about 9 1/3 after inflation. Which
is a good return, especially when you look at it decade by decade. So, okay. So Undersaving is one thing that comes as a result. Spending too much. I mean, you've heard Dave Ramsey say you can have an 8% withdrawal rate, which is outrageously dangerous.
Yeah, he's actually he said that's the conservative rate.
Yeah.
Because he makes 12% on his American funds portfolio.
He's got that covered. So, I mean, but here's the thing. I think what happens is the reason people are overconfident is what we call recency bias. Because you've already forgotten April. Remember April? That was just a few months ago, and the market went down.
What are you
quite
talking
a bit
about? April? Wait. The market's up this year. We hit new highs.
Exactly.
We were down in 2025.
Shockingly. And they've also forgotten a couple other facts I think are very important. This came from Dimensional Funds in a chat we had with them recently. In 50% of the years during the year, stocks go down by 10% decline. Okay, most people can take 10%. That's okay.
Half the years.
Half of the years.
We'll have a 10% scare.
Yep.
Wow.
Yeah.
Okay.
Okay. But most people, not everybody,
ride that
most
out,
people,
particularly if they listen to Talking Real Money.
But here's where the struggle is. It's basically a third of the years where you see during the year a 20% decrease in stock. So if you're in an all-stock portfolio, here's my worry.
That's actually a bear market by definition.
Yeah, exactly. So you're retired or retiring. Mm-hmm. You're starting to live off of that money. You're all in stocks, and your portfolio goes down by 20%, and you're drawing on it. That's when the real trouble starts, because here's what I see happening many times. Then this goes on for a month or two, and people say, I need to sell because this is the minimum amount of money I'm going to need to pay for my retirement. So then they sell after stocks have gone down that 15 or 20%.
Already gone down. You're selling with them lower than they were. You're selling into the sell-off.
Yeah. And that's the trouble, because it becomes a market timing strategy, the I can't stand it anymore index, where you just got to get out. And so that's the problem with being all in stocks. That's the problem with being way overconfident. And then that's the problem, frankly, with believing the stocks make you these outrageous sums. They have not in the past. Let's put it that way.
And that's the problem with continuing to allow we think it's our logical brain, but it's really our emotional brain lying to our logical brain. We're letting our emotional brain control our decision-making processes. We do it when we buy, and we do it when we sell. And the biggest problem investors have, and we've said it over and over and over and over again for decades now, is that you allow yourself to be controlled by your feelings. You don't even realize you're doing it. And you have to wring feelings out of the process. Otherwise, you will not be as successful as an investor as you possibly can be.
Discipline, long-term thinking, and ignoring the noise. A plan. Yeah. All right. Lots of questions. So let's see if we can get to this. One comes from Delavan, Wisconsin. I don't have the name because it's a long story. But if you live in Delavan, and I think I'm pronouncing that right, this is your question. Question is,
it's the town's question.
Exactly. After a major drop in the U.S. S&P, plus or minus 30%, does that sound familiar? How long on average does it take for a 100% VTI versus 100% VT versus a 60-40 VT BND to regain all of its losses? In other words, after the market goes down substantially, although it happens more frequently than you believe, how long does it take to make the money back?
No one can possibly know that. I mean, we could look back and see what
but part of the question was a diversified international and U.S. portfolio versus just a U.S. portfolio.
Again, we only have a very few periods to look back on as evidence, and I don't think that it's going to tell you a darn thing. I mean, generally speaking, the longer your horizon, the better your chances of recovery. And at 10 years, with a globally diversified portfolio, there's never been a total loss. You've always been ahead.
Yeah,
over
but
10
again,
years.
This gets back to, and he's 62, and I did find his name here, Chad. So thank you, Chad, for the question. This gets back to having some balance in your portfolio. You mentioned the 60-40. And every once in a while, I saw it again on a post last night. 60/40 is now dead because bonds have underperformed for 5 years. Oh, baloney. Bonds should be there because you may need to draw on them when stocks go down in retirement. That's the reason you hold bonds, and also to keep you in the markets when they go down. So I think you answered your own question here. I think every portfolio, especially in retirement, should be, yes, globally diversified, but also a balance between stocks and bonds that gives you the cushion and gives you the cash you're going to need to supply your income.
Yeah, and that's really the trick. It's not we're wanting to, and it's not going to work for our little brains anyway. You're trying to come up with a future predictive scenario, and you can't do that. That's why we believe you have to build the portfolio for worst case scenarios. And right now, our historical worst case scenario, and this could change, has been approximate 50% decline in the value of the U.S. equity markets.
Yeah.
It hasn't been as extreme with global equity markets. So what we have seen is that the more diversified your portfolio is, the less time you have to suffer downturns, and the sooner your portfolio is back in the black.
Back in the black. Like the sound of that. From Charlotte, North Carolina, Ivan writes us, "Hey, team, when do you need an umbrella policy? My net worth is about $350,000. And by the way, I did see someone in Seattle recently with an umbrella because it was over 80 degrees. So they had the umbrellas out.
They call those parasols.
Oh, okay. So
umbrellas for rain. You guys know that. You use those in the winter.
Oh, I do not personally, but many people do.
Well, it never rains hard enough.
It's true. Seattle. Well, let's not get into what weather wimps we are really here. Net worth of $350,000. Does Ivan need an umbrella policy?
Probably not, because his regular liability policies typically have about $300,000 limits on them, which covers protecting those assets for the most part. I mean, again, insurance is one of those personal things. It's not a financial thing. It's really not a financial thing, because how many of us, realistically, I know there's anecdotes. Oh, my neighbor got sued because somebody fell down on their sidewalk when it was snowy and icy, and they got hit for $1 million judgment. You know, those are anecdotes. For the most part, most of us aren't going to face $1 million judgments. And if we do, it's one of, you can't protect. And matter of fact, those policies, sometimes you got to be really careful with umbrellas. Umbrellas can be rife with exclusions, things that you didn't expect in there. So you got to read them carefully. Again, with any insurance, it's more personal than anything else. Do you want to bet that you're going to lose? And if you think you're going to lose, buy insurance.
Yeah, I mean, in two recent disasters, it'll be interesting to see how that comes out, both the fire in Southern California and now the flooding in Texas, to see what people actually owned when it came to insurance, whether it just be a regular old homeowner's policy or an umbrella policy on top of that.
Remember, your homeowner's insurance and your auto insurance cover most of your liability issues. But the insurance industry will say, without question, you should always have an umbrella policy. Why do they say that?
They're selling umbrella policies?
That could be the reason. Yeah.
I hate to be cynical.
Do you?
No. Maybe I don't hate it, but I don't favor it. All right. Richard writes us from beautiful LaConner, Washington. I'm 78 years old, married, male, living on Social Security and a pension. I have $700,000 in retirement accounts, both taxable and non-taxable. So I'm assuming that means pre-tax and Roth. Right now, I'm balanced between income and expenses, but I worry about increasing inflation. I read about a LifeX 10-year bond ladder using U.S. T-bills. I would invest $100,000 and receive $1,000 a month for 10 years. So that'd be $12,000 on the 100. I realize 60% of that $1,000 is principal return. The expense ratio is 0.25. Is this a viable option to increase my cash flow in retirement? It seems safe, but what have you heard? We don't know. I don't know the product specifically.
Well, that's why I'm looking it up literally on the fly.
LifeX 10-year bond ladder.
It's kind of like an annuity, a 10-year certain annuity, term certain. I'm trying to find out more about this really quickly.
But I mean, basically, you're giving them the $100K. They're paying you back $12,000 a year for 10 years.
Right. Right. So yeah, they're what they're doing currently. They're paying out almost 12% as a distribution.
Yeah.
Okay.
So a bunch of it's your money. Yep.
3.5% of interest on the treasuries.
Okay.
And 8.25% of your money coming back. For that privilege, you are paying them 25 basis points a year. So
there's a guarantee to all this, right? I mean, that's the difference.
I mean, it's treasuries.
Yeah.
So, yeah.
I mean, you could go own Vanguard's Treasury index fund and for 0.003 instead of 0.25, right?
Well, and here's
this
the
is not guaranteed, though.
Here's the other thing you could do. This is really easy and cheap. Go to Schwab. Set up a 10-year CD ladder or a 10-year Treasury ladder of your own. It's easy to build. They'll help you. The fees will be pretty much nothing, just the spreads. And you could just, over that 10 years, take the maturing bond every year. The maturing note or CD.
It's more work than giving them the money and having them return.
It's more work. So it's, do you want to pay 0.25% for them to do the work? Or do you want to do it on your own?
Yeah.
I mean, it's really what it comes down to. Is it safe? Yeah.
If it's treasuries,
if they're telling the truth, but
Yep.
Again, we're going to have to assume that they're telling the truth because it shows on their portfolios that they're all treasuries. So,
what could go wrong?
I can't. Well,
it's hard to imagine.
I honestly can't imagine anything going wrong unless there is some sort of lying going on. But in the financial services industry, people lie sometimes. I'm not saying they're lying. I don't think they are. They look legit. Their website's nice.
Well, that's a reason.
Yeah, if
I had a nickel for every nice-looking financial website. Anyway, we got time to squeeze one more in?
Sure.
Okay.
Let's do it. We have a lot of questions.
Alexandria, Virginia. Matt
near
writes
our nation's capital.
I like Paul Merriman's four-fund worldwide portfolio for a taxable account, equal parts AVUS, AVUV, DFIV, and AVDS. Those are Avantis and dimensional funds. I like having
ETFs.
Pardon me. I like having four funds so I can rebalance with new money. My question is, when it comes to tax loss harvesting, I'd like to use one fund to approximate the four fund. Does AVGE fit here? Also, what's the difference?
Actually, AVGE fits really well.
Yeah. Then he says, what's the difference between AVGE and DFAW? Not much. There's some differences.
I could look it up, but
I can tell you right now, AVGE holds fewer stocks. It does have more concentration. They're very similar, both in terms of the ratio between U.S. and international and the cost. Mm-hmm. So I think it's a quibble. I really do between those two. But wake me up in 20 years. We'll look at it and see who was right. I don't know. My wife, he says, would prefer the four fund. Similar question, would DFUS be a good tax loss harvesting fund? But that's only U.S., right?
No, that's only U.S. No.
I know you will say this is overkill.
Or DFAW. No, I don't think the four funds are overkill. Do you?
Well, no, he says, I know you'll say this overkill, but I find the rebalancing with new money and tax loss harvesting scratches the investing, tinkering itch for me, and I like doing it.
Good.
Then go ahead and keep scratching.
Yeah, and here's one of the things. If you want an equivalent, the trick, here's a perfect trick. If you're selling an Avantis fund for tax loss harvesting purposes, buy the similar DFA product.
Exactly.
And you don't
They
have to worry about
exist.
AVGE. You don't have to worry about the all fund solution. You can actually go within each specific asset class because they're so similar in their style.
Yeah, these
But
are very good
they're
asset
not
classes.
substantially identical
Yeah, you're okay.
to trigger the wash sale.
Yeah, you're okay. Matt, you're doing a lot of good work here. Maybe, as you say, overthinking a little bit, overkill.
He's got to scratch the itch.
Got to keep
I get
scratching, scratch. So, well done, sir.
I
and
live
thank you for
I live in
writing
Florida
us.
where we have no seams. I'm going to be experiencing those down at the beach.
Anything you
I'll
might
have
scratch
itches.
in Florida might
I'll
not
have
turn out
itches
well.
to scratch.
I think it's bad. All right, that concludes all the questions for today, sir.
Well, then I guess we better wrap up this
I think we
podcast
should wrap it up. Yeah,
right at about 30 minutes out.
Perfect for
that's
me.
pretty good. So, well, actually, it isn't 30 minutes because we had that long delay at the beginning of the podcast.
when Tom didn't show up.
When Tom was out wandering around
Whatever he was
somewhere.
doing, whatever he was
forgot
doing.
where the studio was.
Pretty close.
In his dotage. If you want to ask questions, there are several ways to do it. One, go to talkingrealmoney.com and type them like those people did. Two, go to talkingrealmoney.com and speak them on your microphone on your device. Get a good mic for your computer.
Are you going to send everybody who wants to ask a question a new mic? Is that what you're going to do?
No, they should. You can buy great USB mics for $100.
Wait, you're going to buy a $100 mic to ask you one question? I don't think so.
for your FaceTime calls and for other things that you do on your computer.
You're going to look really smart when you have that.
It's nice to have a good mic.
Okay.
Not as good as my mic.
Well, no, that's
yours. Yours is a $200 mic.
Makes me feel bad. Don't tell me that.
This is an $1,100.
I know. That's what I'm saying. 1/5 the worth of you. I just makes me myself.
But in the grand scheme of podcasting, when we because we compress this down to an MP3 file.
Yeah.
The quality, you're not going to notice any mic quality difference between
Good.
the two.
I feel better now. Thank
You'll
you.
be fine.
Oh, by the way,
that Austrian Audio mic creator is a really good mic.
All right. So if you want to go upscale and
it is
go
a
to
good
$200, yeah, it's good. I will mention, summer's here. Doesn't mean I'm not answering the phone. I'm answering the phone, answering your call. So send them in. If you want some help, happy to do it.
He won't be later in August.
Well,
when he goes on another vacation.
Taking time out from my vacations to do the podcast. So squeezing it in. Speaking of squeezing.
Wait, the other way you can ask questions. I forgot to mention that.
Yeah,
I'm going to mention this one. Every single bloody Saturday, Tom and I actually get together again, like we don't the rest of the week, and we host a live radio show on Northwest News Radio in Seattle that becomes a podcast. The wonderful thing about that, the most wonderful thing about tears, is the most wonderful thing about that is that you can call us live at 855-935-TALK, 855-935-8255, between 3 p.m. and 5 p.m. Eastern Time, noon to 2 Pacific Time. Okay?
Yeah. We get a lot of calls from around the country, and we love it.
Anything else you'd like to mention?
Again, if you want help, go to talkingrealmoney.com, click on Meet an Advisor, and just say, I want to chat with Tom. I'm glad to do it.
I'm going to change the name of the button someday and see if you notice.
Probably not.
You
Don't change anything.
Don't
You just said
change
how
a
hard
thing.
it is for me to find the studio. Why would you do it? Don't move the studio and don't
He's
change
wandering
anything.
around the hall going,
Is that it?
I know
No.
there was a studio here
Wait.
somewhere.
Is that the men's room? No, that's the studio, sir. Oh, okay, good.
That's why the studio sounds like this. All right, take care of yourselves. We appreciate you being there. We do. Honest, we do, right?
Yeah.
Are we in agreement on that?
110.
We're glad you're there. Tell your friends and join us really, really soon for another exciting edition of Talking Real Money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations expectations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.